Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. As always, wonderful to see you all once again. We're back at it. It is it is Wednesday, my dudes. It is Wednesday. I should have put that as like the main image for today's article, but I didn't. But that doesn't make it any less Wednesday. So hope everybody is having a great hump day out there. Yeah, so today on the docket, it's always an interesting day with GameStop, but we're going to take a look at the things that might make it interesting. Some technical points. I think mainly that's what I'm seeing kind of stand out to me right now. We're kind of looking at the same gamma environment. A lot of my analysis, given the degree to which our price seems to be trading so much in line with the broader market, does end up going towards some of these broader market factors I look at. I don't go ahead and trade the indices. I don't do that, but I don't know. Maybe I should. I don't know. I'd certainly make more money if I did that, but that's not what I do, and that's not why I pursue this project per se. Right, my interest is to focus on GameStop. Right, full disclosure, I only trade GameStop. Only invest in GameStop. That's my only position, besides cash. Right, to quote Roaring Kitty. So let's get into it today. First off, we have our daily bit of gratitude here. A blessed Ash Wednesday to any of you out there who may be. Well, celebrating is perhaps no, it is a mass. Celebrating mass in honor of Ash Wednesday. That word is appropriate, right? But we remember today that we are dust, and to dust we shall return, as our father Adam before us. So thanks go out once again, Steve Salo, for sponsoring today's newsletter and today's video. Thank you, my friend. And as well to Dat Scruffdo and Ken Wedmerlin. Thank you both for pledging to support us here at 21st Century Renaissance on a regular basis. Thank you very much, right? You all three of you, and everyone in the past, everyone who has contributed so far, helps keep all of this content completely open access, free to everyone, and no paywalls, no monetization at all. So thank you very much. I deeply appreciate your generosity. So fun times. Our 69 guys back once again. That's trade number 8. That is Exto. That is, let's see, after hours. What is this? It's the Exto period. So extended hours overnight trading, right? We have one trader, it seems, who keeps doing these types of trades, who is able to get off a trade that is, it's always one share, and it is well above or below wherever we are trading. Usually it's above, but it is well above or below, anywhere that we trade during the day, and does tend to coincide, I will mention, with certain technical levels. It usually comes to within a couple pennies of a technical level, of course, though, but it always ends in 69 cents. That's what's so stand out about it. Interestingly, this is, I think, the first time I've seen two come down the horn in a row. So yesterday we saw one for 25.69. It was the second such trade at 25.69. We saw one come in at the 25th of February at 25.69 before we began a 2-day movement to the upside, which culminated in a pre-market very quick pop up to 26.20 off of a low of 23.83. This time, yesterday, we logged a low of 23.44 within a few pennies of our 50-week moving average, a very deep support level, to 20.69, right? So moved up $1, but still a 69 trade, and this is the first time we've seen that occur, back to back here. So really continue to point these out. I would say, right, this looks like someone trying to signal something. It looks like somebody potentially trying to mess with maybe some of the algorithms, or just kind of make a mockery of the structure of this whole thing, and kind of point out maybe the trading algorithms. So interestingly, right, in order for this trade to keep happening, right, I believe it's Ultimator is the one who pointed this out, the Ultimator 5. This trader, number one, needs to be using a script. So this has to be a trader that knows how to code. That's number one. Number two, this trader has to execute this script in such a way that an order will go through like the moment that the overnight market opens, so that this trade can get in before the dealer can load the order book, and therefore the algorithms that run buying and selling in this period, right, that manage these trades, automatically take this trade because the order book is blank. So that's what's very interesting, and I guess it falls within a certain, like, non-danger range or something, so they take it. So, right, it could be a person just trying to screw with the algorithms, maybe trying to send us signals. The 69 is very conspicuous. Don't know who this would be. Maybe it is Roaring Kitty. I'm not sure, but whoever this is has settled on every trade ending in 69 cents. But maybe it's a sign. Maybe it's an individual trying to point out where our price action might go. Hard to say. I won't speculate too much. But yeah, interesting to see another one of these. Trade number 8. Trade number 8 of these that we've seen since January 13th. No, excuse me, January 6th, 5th or 6th, I think. So very interesting. In terms of what we saw yesterday in the broader market, right? We did, of course, get this bearish day yesterday. Started off bearish, then we recovered pretty well throughout most of the day, which was nice to see, given that SPY really did not recover so well. So SPY, more or less our price action kind of stuck with SPY's archetype, but I would say that GameStop looks to have recovered a bit better versus that. SPY did go ahead and fail that did break through that 580 put wall to the downside, right? We kind of tested with it a lot pre-market, and then really we started to recover, and then as soon as we kind of got that break pre-market, recovered a little bit, and then as soon as things opened, we really moved down very fast and very hard to a low on the day of 572, a level we've not seen in really quite some time in the S&P. We scrub a dub down there a little bit before then going through a pretty decent recovery on the day, and then move back down sub 580, so move through that level again. Pre-market right now, we're about a half hour out from market open. We're looking at trading at around 576, 575, if I got that right. Yeah, around 576. Again, right, we have this setup where if we have these major, positions of put accumulation, if we go through these levels, right, if these don't provide a catalyst for something of a reversal, then we're set up to move down pretty hard and pretty fast to the downside. So again, we're looking kind of like yesterday. Yesterday had a put wall at 580. If we breach through that today at 575, it looks like a run down to about 70. 570 is another really big put position. If we move through that, and we have, right, if we bring this up, right, we have a lot of puts accumulated in between these strikes, right? It's not like we have above us. Above us, kind of more neutral. 580, again, still a pretty big position. But right, yesterday we stopped in this neutral area, in this blue box, right? Dealer gamma, not sympathetic back to the upside, right? So, right, the thing with trader long puts and dealer short puts is that with a dealer short put, the dealer's delta is going to go up as the price goes down because the trader's delta is going down. That's the same with gamma. It's especially true with gamma, right? Gamma will peak as you approach strikes, well, a certain strike price. So, for example, the gamma at 575 will peak as you are moving into the money for for 575 to the downside. So it's going to peak right there. So that kind of peaking there, you get a little gamma effect, you get a little Vanna effect coming in. So IV will spike as that happens, and that'll cause the delta to go up. So you get a little gamma, and you get gamma kind of falling off a little bit, and you get Vanna kind of pumping up delta a little bit. Gives that a little kind of a little bit of a cushion at that particular strike. But then if you move through it, you can get through that kind of slight bump up, and then other strikes down below it can kind of take it and you'll slide down. So we do have an accumulation of put gamma in between there. So if we fail 575, even 576 kind of slippery, but if we fail 575, it looks like, again, kind of like yesterday, we'll just kind of shoot down here, test 570. If 570 we shoot through, then we'll probably move down into the 560s. And then I really think, from the looks of it, technical wise, market wise, next stop is kind of this 565 area, even though it is also a heavy put area, given the fact that we have the 50-week moving average there, and then we have this historical level. So this was the bottom of one of our all-time high runs, and this was the top of one of our all-time high runs. So last July, this is actually, this price level, 565, is where the S&P peaked just before the Nikkei crash last summer. So we peaked at 565, right, and then used 565 as a support when we went for the all-time high. Actually after the election, so after last November. So it's probably going to be something of a hang-up, kind of a bounce point. I would say, based on how our momentum is looking, SPY's move to the downside is kind of just getting started here, but I could see that as a decent kind of bounce point, maybe recovery point. If we move down there, I could see potentially a lot of these March put holders moving out of their positions, possibly closing some of these positions. Doesn't look great going into 3.7, but maybe we get some of these March OPEX put holders closing out their positions, something like that. But maybe not, right? Maybe not, right? Well, they might do something like roll those puts out to April, right? So maybe hold an April put position if they're afraid of maybe what's going to happen with the Bank of Japan decision. What is this probably? I would say this that we're looking at right now, I would guess, as we've talked about earlier, a large part of what we're seeing now in the broader market is this Bank of Japan decision being priced in. A combination too, COVID loans, right? PPE loans are coming due, margin loans from COVID are coming due. So this is resulting in a contraction of liquidity. Oops. So, okay, but without kind of going too deep into the market there, still looking at, as I've called it here, right, big bear life. So we're still looking at the big bear life, basically into March OPEX. We'll have to see, right? That's a huge put gamma expiration, right? So more than, look at this, almost half of all of the put gamma on the board, right? Almost half of all market maker gamma exposure, put gamma exposure, just net put gamma exposure, is concentrated at March OPEX. So that's a huge put expiration. That's a huge put gamma expiration. Very interesting to see what that's going to look like. But much prior to that, I wouldn't expect too strong of a reversal to the upside. It will likely depend to a certain extent on what we do maybe around that 50-week moving average. But speaking of GameStop, right? And 50-week moving averages, GameStop looks like, right? You really kind of have to squint to not, to see the gap between the wick, the downward wick of our weekly candle there and the 50-week moving average. It looks like, we went down, almost touched the 50-week moving average. So right now the 50-week is at 24.38, I think, 24.38. And we reversed at 23.44. So came to within, pennies of that level, that very deep support level. Yeah, it'll be interesting to see if that indeed functions as a technical support, if we get something of movement back to the upside. Have we used that level, right? I mean, we did use it as a resistance point at a couple times last year, right? So, well, really in 2023. Not really very much in 24. But yeah, I mean, kind of sort of a deep support, but kind of with a few dollars to spare there. It's going to keep moving up. We can see that, right? So basically, as these weeks here come off the board. As we move each one of these candles out, this is still going to move up until we get into the kind of 25s, 26s. So, this is kind of it's kind of a crossroad. So, I mean, basically, this makes it look like either we reverse to the upside, maybe trade between these two moving averages, trade between the 200 weekly and the 50 weekly for a little bit, maybe into March OPEX here, and then kind of move to the upside. Or we maybe fail this and then go down to like 20, which that would be bad. I wouldn't like that. But, I mean, I guess, who knows? Do we end up looking like this, right? Like just, wow, amazing, right? Wow, amazing into the end of the year. Don't we actually kind of look pretty similar to this formation, don't we? Right after the new year, except for one candle, right? Our first candle of the new year, great. A second one, no, right? So immediately move down. Yeah, we look conspicuously, right? Conspicuously similar to some of that pattern there heading into, this is into March OPEX, right? This is the first quarter. So I don't know, maybe we get a little reversal right here up to this 200 week moving average into the 27s again. Would be basically, that would be the week for it, I guess. I guess that's quarters. That would be for like April OPEX, I guess. Not April. Yeah, April OPEX, something like that, or second week of April. So yeah, maybe we move back to the upside here if we're going to look like this, right? So first off, why would we move like that, right? That's kind of the question. And like, why would we sell off after this, great bullish third quarter earnings in 2023, right? We did the same thing. We had great bullish third quarter earnings, 2024, better than expectations, right? Both of these moves, very good. And then sell-off, big sell-off. Basically, all of the gains from earnings, the kind of earnings heading into earnings, coming out of earnings, all of the gains basically sold off. Why? What's going on there? So definitely, if you've had a chance to, if you watch Richard Newton regularly, or if you follow users like Always Sad But Truthful, or if you follow Ultimator, right? The big question and the theory, I guess, leading theory is, well, maybe they do this in order to account for swaps, right? Because we don't necessarily, right? There's a lot of volume up, but then not equivalent volume down. This is the interesting thing, right? Big volume up, not equivalent volume down. Big volume up, not equivalent volume down. So, what really occurs that doesn't look like you would expect from a typical accumulation? Well, I mean, actually, what we see here, this pattern is basically, it's still accumulating, right? Because we're seeing big volume up when the price goes up, and then the price moves down, but it kind of trickles. This says, by classic, Wyckoff distribution, like accumulation and distribution theory, this is a quarter. The distribution isn't happening, right? There's no capitulation. This big move down actually is just kind of a, what would you call this? A short-term correction. It just lasts a quarter, right? A short-term correction, and then it's going to prepare itself for a bigger move to the upside, right? Something like moving up into the 45 to 50 range or something like that, based on how this looks, right? Or I guess up into the 45s. That does look like it's on the table. Still have upward momentum. Looking at the RSI, this is the lowest RSI value we've seen in basically since the bottom back in April OPEX, right? And then of course this got so low that this huge explosion off of this like multi-year low, this technical level and RSI level and what have you, as well as whatever was going on with swaps at the same time. So maybe something like that, right? Maybe this is moved down during this period of time in order to roll swaps. And then once the swap is rolled, this is big credit to Richard for pointing this out too, and sort of tracking these lows. Once the swap is rolled, then the price can go, right? That institutions have to get the price down so that they can mark their swaps lower, roll them so that the interest rate isn't crazy, or that so it doesn't show that they don't meet capital requirements on their books, or something like that. Because right, while it's all bundled up in a swap, right, it's not priced until they're marked. Right? Remember, like when Michael Burry in The Big Short is all upset because like Deutsche Bank and Morgan Stanley like won't mark his swaps, like they won't price them because it's not in their interest to do so. Like if they do, it's going to cause liquidity problems to them because they're not making capital requirements. So they refuse to accurately price and mark his swaps. He complains, right? Michael Burry is complaining that is Christian Bale playing Michael Burry is complaining. He's like, I don't understand how a security's price can remain high even though the asset that it tracks is completely collapsing, right? And he's complaining about the mortgage-backed securities. And he's saying, how are these mortgage-backed securities not collapsing in price if the housing market is going into default? How is the price on these securities remaining elevated? And from like Deutsche, he gets something like, well, it's very complicated, right? He gets a bunch of word salad. And that's when he goes like, oh, he hangs up the phone and he's all upset and he's like, and he yells and stuff like that. And so, right, how is the price remaining high? Well, institutions can keep the price high so that their swaps get marked in a way that is favorable to them, right? So they're not charged these super high premiums on it. So they didn't have to pay. So Michael Burry had to actually keep paying these super high premiums on his swaps, and they were being marked as though they were not, they had not been increased in value. So each checkpoint was coming through. The housing market was collapsing, but the mortgage-backed securities themselves weren't having their prices adjusted downward appropriately, and so he was having to pay these huge premiums. So they can do something like that here. Let's say you're shorted, but now you're underwater because the price is way up, right? If it goes way up, you might get marked, right? Your swap is going to get marked that you're way underwater on your position if you're the short party, and then you're the one now that's got to go ahead and pay these crazy premiums for however many months. So maybe the strategy there is walk the price down basically as low as you can using all of these kind of price engineering methods, strategic fail to deliver, ETFs, shorting, strategic order flow rerouting, manipulation to the options market. Use all of these tools. Get it down as low as you can. Get the swap marked. Once the swap is marked, you've moved it as low as you could. Once the swap is marked, okay, let it, close your FTDs because you got to get those off the books now, right? Those you only entered in, not because you thought they were a good bet. You entered them because you needed to mark your swaps. So you move out of those positions, you take your finger, you take your foot off the gas, you take your finger off the scale, and then you can let the price go up at that point. Now, what may have been the case, right, last year is it may have been the case that this happened once, and then there was another swap roll that needed to happen in April, maybe a much bigger swap roll, something like that. And so for some reason, right, they just decided to super drive the price of this into the ground. Got a swap rolled here. And then once you had kind of the double pressure, because right here, basically going into earnings was a surprise beat. So they were prepared to control the price in here. But once earnings was great, first off, they had to control that buy pressure that came onto the tape because of earnings. Then they had to close this position going into this swap roll in March before earnings. Then they had to control the price in order to make this swap favorable heading out of April OPEX. So then once they got on the other side of April OPEX, they basically had three kind of waves of buying that were all basically stacked on top of each other, maybe even with other swap rolls in May or June coming due. Last year, there were a lot of swaps that were also due in May and June, and maybe whoever just decided not to renew those or something like that, not really sure. Maybe they were also FTD. That was responsible for our July run, was kind of the FTDs on that. But in any case, right, maybe what made this, beyond there being these great technical catalysts, was just three waves of buying that had to be controlled, contained, internalized, kicked down the road. control, contain, internalize, kick down the road, right? 3 waves of this, and then all of a sudden, bam, everything had to get covered all at once. Something like that. So are we going to see something like that again this year? Not sure, but given the similarity of how our prices move down going into the end of the year and then coming out basically into March, right? The same time period, we have a remarkably similar weekly progression in terms of our price downward on, a similar looking volume coming off a really good Q3 earnings. So, the same kind of setup here. So, very interesting parallels there. And if that's the case, right, this should be right around mid-March, right around March OPEX. Within the next week or two, if right, always sad but truthful thinks that the major swap roll was yesterday. And Ultimator too pointed this out. Looked like there was some major swap activity going on, or at least major fraud activity going on, right? Price engineering, very intense intraday toward the end of the day. So, yeah, maybe, right? Not seeing too much in terms of, direct shorting or anything like that. Not too much detectable dark pool wise, options market neutral. So, yeah, I think it's as far as I can make sense of this, that's a pretty good theory. That's kind of my leading theory for what's driving our price action right now coming out of this setup. But okay, given this similarity, does that mean that we're in for another like April mega sell-off? Oh, that would suck to sit through. But we'll have to see. We'll have to see. I'm not sure what the April kind of if there's some sort of April swap roll as well that maybe this would coincide with. In any case, options, kind of boring. One person did open like 1,400 puts at the ask yesterday at 22.5. So, sorry, dude. Hopefully, I mean, look, man, whoever you are, yeah, I hope your trade loses. That's what I have to say. Or at least I hope you're hedged, right? I hope that's not in the money in like 3 days. By Friday, that'd be mega lame. But anyway, best of luck to you. Never root for the long put trades, right? Covered calls, that's one thing. That's limiting. That's just kind of limiting your upside. Like, if it goes up, you get assigned. Like, all right, whatever. But the long put trade, hard to root for that. Hard to root for the long put trade. Gamma exposure wise, yeah. So this is what I was talking about in terms of like a spring loaded. We continue to have this super dense, high call gamma dominant environment above us. We're in this IV, right? IV is continuing to kind of move up. We're still moving up. Okay, we moved down a little bit. Our trend is kind of corrected a little bit, but we're still gradually moving up. If we have even the slightest bit of dynamism to the upside, IV's going up with it, especially if we move above 25. IV's going up with it. Hedging starts to kick in. You're going to have extra delta hedging from the Vanna effect, and you're going to have a lot of shares are going to be hedged from starting to, I guess, from the sensitivity a lot of these very heavy call gamma accumulation spots here. Now, will market makers, will options dealers allow this to happen? Well, they're going to try and get this controlled as close to max pain as they can. But right, we've seen how they manage, kind of a bull trend if it is time for us to move into a bull trend. And really, that is let things start out pretty dynamic, right? Let things kind of midweek happen dynamic, and then kind of walk it down a little bit. And what happens is you'll draw in enough buyers that'll get kind of overeager on the call purchases that options dealers will then be able to offset losses in this area by traders coming in and buying way overpriced stuff because of the IV hike at out of the money strikes in the hope that it'll just go even higher and faster and et cetera, or trying to gamble on quick flipping some of these options contracts, the 30s especially. And as you can see, right, 30 throughout all of this, even as we get pushed down, and this is how you can tell this is not organic, right? for us to be this far away from 30, to be moving into the 23s, and yet our call wall is still $30. Our call wall is still $30, right? Our call wall yesterday, even with our price at $23.44, was still $30. Now that's different than what we saw, say, in July and August. And this is why I want to point this out. July, August, September, October, like, was there, I guess his ultimator, right, would say, was there fuckery afoot? Some, right? Like, yes, I'm not going to say no, but not this level, right? Not like this. A lot of that was just kind of organic flow through the options market. And you can go back and read, right? We can talk, go take a look at, I have all my articles back into, I think, into late July. My June and early July stuff, unfortunately, was deleted when I lost my Reddit page, when my account was banned. But the late July stuff is there. The August stuff is there. The September stuff, October stuff, it's all in there. There definitely was price control. There definitely was some price engineering. It definitely happened. But it wasn't so consistent as this, right? There was definitely a lot more play in the options market. And I think institutions were also a lot more willing to allow that play in the options market, or maybe they were happy to profit off of them, profit off of some of these movements in the options market themselves. That's not really what we're seeing, right? So when we saw the price move below 25 in July, right, the call wall moved with it. It was like, a week, maybe 2 weeks before the call wall moved down to 25. When we moved down to 18, had that rundown with the Nikkei crash, call wall didn't move from 25. So saw that, went, oh, okay, we're probably recovering back up into kind of like the mid lower 20s because that call wall didn't move. That's not authentic pricing from market participants. That's price engineering. What we see here is like, we don't see, okay, we see kind of the 29 area, like this is faded off a bit. But basically, like, to have the price move down all the way into here, but $30 still stand out as the call wall, like not even 25. I mean, do we have a lot of gamma at 25? Yeah, positions have been open at 25. But week after week after week of trading in this range, kind of staying close to 25, even moving below 25, 25 itself has not emerged as a replacement call wall for $30, like we've seen in the past. So that's what kind of tells me, like, we seem like we're in the good candidate for kind of moving back into this range. And this area here is so sensitive from gamma and from implied volatility. Whenever whoever is done with their swap rolling, right? I mean, I'm not someone who can track that very closely, but whenever they're done with this, like, this could run back up, like, basically into $28.50, $29, and like, $28.50 probably run out because we don't have a lot of gamma concentrated in that area. But basically up through like 28 into like 28.50. It could do that in a day, right? Like if there were no price controls right now, and there were some little bit of something to kick off this kind of gamma ramp, like, you could see something like, like September 20th, 60 million shares in a day, and then the thing just goes nuts to the upside, like $3-4 in a matter of hours. Like, this is set up for that, but this has been set up for that a lot of weeks in a row, and it's continually been blocked, prevented from happening from the upside due to this type of price engineering from the looks of it. So, hey, I bet on one that I thought was a good chance back when we had some of those FTDs back in probably settlement. This was like February 10th to February 14th, right? Looking good. Bet on some of that to the upside, a little bit to the short term. Didn't work out, right? Didn't work out despite the fact that we had signs looking good. So staying cautious here, pointing out that this is possible. It shouldn't come as a surprise when it does. But yeah, it's going to be contingent on whenever they're done with this. If this is indeed swap rolling, which seems to be the most convincing thing to me, right? Price engineering to control swaps. Yeah, that makes the most sense to me. Whenever that's done, we'll up we go, I suppose, to say the least. But yeah, that's it for today. We will. Yeah, we'll see what we look like, guys. Right? You just gotta have a little spirit of adventure, right? Like that's how I always approach this, right? Have a little spirit of exploration. Just excited to find out, right? I go into the day and be like, okay, the fundamental thesis is in place. We've seen institutions accumulate significantly. Does it mean they can't manipulate this further to the downside? No, it doesn't necessarily mean that. That's always, part of what's in play. But try to make conservative trades to protect the position when possible. Try to gauge maybe some of these swap cycles. Now is the swap roll cycle. That's another element we have to deal with now, right? Or have been dealing with, but just to factor into really getting something a little bit more precise with our price forecasting model here. The only way you can do it, right, is to have that spirit of adventure. Let's see what happens. Let's see what they can actually do here, and especially knowing what we know about the fundamentals of the company, that's a lot more, makes things a lot more fun. So that's it for me today. Thanks of course, as always. Every day, you can go and check out my article over on Twitter. It's linked down in the description. But yeah, we'll see you tomorrow. Let's see what we got in store. Well, yeah, bye.